Hello, and welcome to Portfolio Matters Week 97 Weekly Update. Before I get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have financial interest in. Please do your own research or consult a professional investment advisor for making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Now, before we get going, some housekeeping. First of all, I'm very much looking forward to seeing as many of you as possible at the pub night on the Monday, the 19th December at the Princess Louise in High Holborn. Also, this week is going to be quite a short episode because it's a Monday and Richard is working, sadly, and I am just about to fly off again to Budapest. So it'd be short and sweet today, and I will do the next one next weekend when I am back. So news this week. Well, China has begun to ease COVID lockdowns, but they have a problem in that they have very low vaccination rates amongst the elderly, and they're forecast that if they ease lockdowns, then they can expect up to 1 million excess deaths this winter. So there will be consequences either way. They continue lockdowns, then the economy is not doing very well. If they ease them, then a lot of elderly people could die. EU sanctions on Russian oil came into effect, and that has led to logjams in the Bosphorus as Turkey has closed the Marmara Straits to oil tankers without proper insurance. And so the sanctions have stopped Russian oil tankers from having access to Western insurance. Currently, there are about 16 Russian oil tankers unable to export via the Bosphorus. Let's see what happens. Strikes begin in the UK. We face a winter of discontent. Looking at the tube map, it seems that essentially service is going to be disrupted for most of the next month. Also, the Bank of International Settlements has warned that there is a hidden $80 trillion worth of debt in the world in the form of FX swaps. So what's happening is corporations outside the US are borrowing in local currency and then swapping it into US dollars. And that liability seems to be largely unaccounted for, creating additional risks for the world economy. So Friday last, we had US non-farm payrolls, which beat expectations and depict a US labor market that continues to do much better than expected. We have a section coming up on that. And last week, US producer price inflation also beat expectations. So the UK faces a winter of discontent as unions strike against the government's pay offer, which is well below inflation. So the public sector faces a cut in real earnings. Now, this chart shows the estimated number of strike days lost over history, and you can see in perspective, the strikes are nowhere near as bad as they were in the 1970s and 80s. So we can only wait and see what happens. Okay, this week's economic data. Well, Friday last, we had US non-farm payrolls, and they came out unexpectedly strong. And that led to a sell-off in US Treasuries as the market expected the Fed to have to raise rates faster and higher than previously. The headline US non-farm payrolls was better than expected, coming in at 263,000 in November, which is down on October, but massively beat expectations of 210,000. Hourly earnings were also better than expected. They came in at 5.1%, which was up on October and well above expectations. So the non-farm payrolls is portraying a US labor market that remains tight and wage inflation remains well above the Fed's 2% inflation target and is persistent. Month on month, average hourly earnings in November came in at 0.6%, up on October and well above consensus expectations of 0.3%. We also had the US ISM non-manufacturing PMIs, and again, they portrayed a US economy that was doing much better than expected, and they showed a bounce in service sector activity. So the headline PMI came in at 56.5, above October and well above expectations. The expectations were that activity would continue to decline. Instead, it bounced back. Non-manufacturing activity bounced very strongly. It came in at 64.7 in November, well above 55.7 in October, and massively beat expectations of 54. So the ISM non-manufacturing activity index shows that business is bouncing back in the services sector in the US. Now, prices were below expectations. The index came in at 70, down on 70.7 in October and below expectations. So that at least is positive for rates and inflation. So price pressures in the non-manufacturing sector seem to be steadily declining. The new orders index was 56 in November, below 56.5 in October, but well above expectations. We also had producer price inflation, and that again beat expectations. In November, it was 7.4%, which was well down on October, but slightly above expectations of 7.3. So producer price inflation in the US is falling, but it is not falling as fast as analysts have been expecting. Core producer price inflation came in at 6.2% in November, down on October, but again slightly above expectations. Moving on to the UK, we had the UK Halifax House Price Index, and that came in much worse than expected in November. So it was expected at minus 0.1%. It came in at minus 2.3%. So the UK housing market is slowing rapidly. Year on year, the index came in at 4.7 compared to expectations of 7.1. The UK mortgage rate also rose higher than expectation. It was expected at 5.5%. In November, it came in at 5.88%. So home buyers face rapidly rising interest rates, and that is having a very predictable negative effect on the housing market in the UK. We also had some quarterly numbers for the EU, and Eurozone GDP growth came in at 2.3% in Q3 year on year, and that is better than expected and shows that the EU economy is actually proving to be more resilient than we had expected. Okay, some charts. So this is US non-farm payrolls. Now I have a special section on this coming up. You'll see that according to the non-farm payrolls, the US jobs market continues to produce jobs. So job creation in November continued to fall, but very slowly. The jobs market in the US, according to non-farm payrolls, remains tight. But there's a huge gap opening up between the household survey and the non-farm payrolls, both of which are surveys of US employment. And the household survey is showing much less jobs creation than the non-farm payrolls. I've got a section on this coming up, and we'll go into that in some detail. Now, according to the non-farm payrolls, hourly earnings continued to be strong in the US and rose in November. And part of the reason for that is that the participation rate remains very disappointing. So there aren't enough people going back into the labour force after COVID. The labour market remains tight. Now, this is producer price inflation in the US. It is declining, but not as quickly as the consensus had forecast. So the ISM non-manufacturing PMI had a decent bounce in November, which was not what we were expecting. And the activity index had a big bounce, bouncing from around 55 to around 65. Prices paid, thankfully, continued to drift, and new orders also fell slightly. The US 30-year mortgage rate is off its highs and seems to be steadily declining now as long-term interest rates in the US fall. So the market is coming to believe that the US will get inflation under control. Initial jobless claims in the US, they seem to be steadily rising now. And continuing jobless claims are definitely rising. In the UK, we had construction PMIs, and they remain just above 50. So the UK construction sector is in expansion, but only just. UK retail sales had a good November, up 4.1% year on year. Although remember that UK inflation is 11.1%, and this is not adjusted for inflation. So in real terms, UK retail sales are down about 7% year on year. This is the UK Halifax House Price Index month on month. Sharp falls. The UK housing market is slowing. And this is year on year. And this is the UK mortgage rate, which continues to rise in contrast to US mortgage rates. Remember that in the US, most mortgages are 30-year. In the UK, they're 2 to 5 year, and that might explain the difference. This is the EU construction PMI, and that is falling and below 50. So in summary, US producer price inflation is falling, but not as quickly as forecast. The ISM non-manufacturing PMI survey for November was strong, with a good bounce in activity, which was unexpected. But we have previously reported the S&P Global non-manufacturing PMI, and that paints an entirely different picture. So there's a big discrepancy opening up between the ISM and the S&P Global indices of the service sector in the US. We've got a section on that coming up. US non-farm payrolls also beat expectations, but again, there's a big discrepancy between the non-farm payrolls and the household survey. So we're getting a lot of contradictory data. Onto one chart. So this chart shows that over the past 10 years, the world has added $80 trillion in debt. So over the past year, we've seen a very sharp rise in interest payments, and every 1% rise in interest rates means that debtors need to pay a further $800 billion in interest to creditors. And that will tend to suck demand out of the system as debtors need to divert money from consumption to paying interest, and savers tend to save rather than spend the extra interest. But the big danger is that debtors have taken on all this extra debt in the expectation that interest rates would remain very low for a long time, and they've risen very quickly, and that is likely to cause over-leveraged borrowers financial distress, and we are awaiting the first signs of that. Generally, when interest rates rise this quickly, you get distressed borrowers going bust, and we haven't really seen that yet, and I am expecting that to happen. Okay, on to Inflation Watch. So we had no new data this week, but a reminder, UK inflation is currently at 11.1% in October. The US was 7.7% in October. We're hoping to get new figures for the UK and US next week. In the EU, Inflation is at 10% as of November. In Japan, it is at 3% as of September. In the US, inflation surprises have continued to fall, and we're seeing lots of indications there that inflation has peaked. It's a question now of how quickly it falls back towards target, and if it does, how persistent is inflation going to be? And another factor which is adding to the fall in US inflation is the fall in M2, or the stock of money, which is now negative. And you can see here that there is a good correlation between the rise in the monetary stock and inflation, as you would expect. But the correlation is not perfect. So although inflation is likely to follow M2 down, the speed with which it does so is uncertain. In the UK, so this chart shows food inflation as taken from prices in the supermarket, and it shows that food inflation has been very strong, much stronger than other household items, and that will affect the poorest households the most because they spend a higher proportion of their income on food. Thank you to Liebod for sending us that chart. In the US, the Mannheim Used Car Index is now negative, and if the historic relationship between the Mannheim Used Car Index and the CPI component for used cars and trucks holds, then would expect the CPI component for used cars and trucks to also turn negative in due course. A side effect of the fall in used car prices is on the price of PCPs, which is the main way consumers buy cars these days. So a PCP is a personal contract purchase, and so it involves a consumer paying a small amount up front, followed by typically 3 years of monthly payments, followed by a terminal payment. So the monthly payments are a function of interest rates and the expected fall in the value of the car from being a brand new car to a 3-year-old used car. And as used car prices fall, so the expected depreciation over those 3 years falls. So the monthly payments needed to compensate for that fall rise. Bottom line, falling used car prices mean PCPs become more expensive, which reduces demand for new cars, which is bad for car manufacturers. So this month, we've seen that PPI is falling, although it fell less quickly than consensus forecasts. If the historic correlation between CPI and PPI holds, then that should mean CPI falling below 6% in the coming months. Reminder, CPI in the US is currently 7.7%. So that would still be well above the Fed's 2% target, but based on PPI, CPI should continue to fall sharply. So earlier we had wage data, and that showed that wages were continuing to show strong year-on-year growth. And if we break that down further, you'll see that most of the wage inflation is concentrated in the young. So young people aged 16 to 24 in the US have seen wage growth of 13% year on year. 25 to 54-year-olds, 6.3%, and 55 plus only 4%. So that suggests that a lot of the wage growth has been for relatively unskilled labor, and that is good for inequality, but bad for inflation, as the young presumably have a higher propensity to spend their increased wages. Now, the market is expecting inflation to fall rapidly to below 3% next summer. So a lot of the fall in inflation appears to already be priced in. The danger is that the market is actually being too aggressive in its disinflation expectations. And if we look further at the drivers of inflation over the last few years, you'll see that expectations are that many of them will turn negative over the next year as very high commodity prices, for example, fall and commodity price inflation turns negative. We have seen this week that oil prices are now negative year on year. But of course, wage growth remains strong. And so, although the market is expecting inflation to fade quickly, if the labor market remains tight, then the danger is that wage growth continues strong and inflation remains persistent. In order to meet its 2% inflation mandate, the Fed is going to have to create some slack in the labor market. And that means continuing to raise interest rates and keeping them there until the labor market slows. And that means a recession. Average earnings growth, this is hourly earnings year on year, continues to remain elevated, shows very little sign of falling. So in summary, all the indications are that inflation has peaked in the US. The question is now not how high inflation will go, but how quickly it will fall and whether it will fall back towards the 2% target or will remain consistently higher than pre-pandemic. Okay, onto recession watch. So this is the JP Morgan Global Composite Output Index, and you can see that it is falling and is now below 50. And if the historic correlation between the composite output index and global GDP holds, then that should mean the world economy falls towards recession in 2023. Although right-hand axis would seem to indicate that the falls in the composite output index are not sufficient to predict a global recession next year, just very low growth. And one symptom of slowing global growth is Chinese export orders fell 8.7% in November. So one of the reasons that China may be relaxing its COVID restrictions is that the economy is slowing and it needs to get people back to work. And container shipments to the US from China are now down 21% since August. So that indicate rapidly slowing goods demand in the US. In the US, financial conditions have tightened a lot over the last year, but over the last couple of months, they have eased from around 101 to 99.8 on this index. So that is stimulatory and makes the Fed's job harder. Now, we've talked many times about excess savings, and this forecast from JP Morgan shows that they're expecting the stock of excess savings to be depleted by mid next year. So this suggests that excess demand caused by the fiscal stimulus during pandemic is likely to be exhausted by mid next year. Now, goods predictor of recessions is the hiring rate for temporary employees, because they're easier to hire and fire than permanent employees. And generally, you see a fall in temporary employees prior to a recession, as you can see on this chart. Now, currently, the hiring rate for temps remains positive. So that doesn't indicate an imminent recession in the US. The rate is falling, but it's not yet turned negative. US construction spending is responding to higher interest rates, and you can see it is falling, particularly in the residential sector. Obviously, there's a big lag involved in these numbers as projects that have been started need to be finished. In Europe, the PMIs look really awful, although the data suggests that the EU economy was surprisingly resilient in Q3. The forward indicators, though, don't look good. So in summary, global PMIs are continuing to fall. Chinese exports are falling and falling quickly. So the global economy continues to weaken, but it is not yet in recession. We expect it to continue to weaken as interest rates continue to rise and stay high for a period until inflation comes under control. So monetary policy acts with a lag, and over the coming months, interest rates will continue to act to slow the world economy, and we are expecting a recession in 2023. Okay, on to the European energy crisis. And in London, it's snowing. The cold weather we were talking about over previous weeks has arrived, and it's forecast to last until later in the week. This is forecast until Friday. Next week, temperatures are expected to rise. Well, the good news is that gas demand in Europe is well down on previous years due to conservation measures and demand destruction. So that bodes well for getting through the winter without consuming all of our gas stocks and having to resort to rationing. But cold weather has led to electricity price rises over the last few weeks in Germany and in Britain, although prices are now falling. In France, remember, they put caps on energy and prices have been fairly stable, although EDF have warned that there may be power outages later in the winter if the winter is particularly harsh. This is Italy. So, in conclusion, winter is here. It's started. And how bad the European energy crisis gets remains very weather dependent. It has started well, but it could yet get much worse. France has warned of possible power cuts, and that could have very bad consequences if you think of, for example, chairlifts in ski resorts. Okay, now on to US non-farm payrolls. Now, they came in hot, as we have covered, and that caused a rise in short-term yield. So this is the yield curve before and after the non-farm payrolls. So red dotted line is before, solid blue line is after. So it caused a rise in short-term rates as the market expected the Fed to have to raise rates higher for longer to get inflation under control. But the medium-term trend remains intact. The US non-farm payrolls is steadily declining. Now, the problem with the non-farm payrolls is that it seems to contradict the household survey. So the dark brown line shows the employment level, the number of people employed in the US according to the household survey. You'll see that since March, it has only risen by 12,000. In contrast, the non-farm payrolls has risen by 2.7 million. And that is a huge difference. Full-time jobs, according to the household survey, have actually fallen by 400,000 since March. So there's an enormous difference between the two surveys. Non-farm payrolls show a steady rise in employment. The household survey shows no such rise and actually a fall in full-time employment. So the non-farm payrolls is a survey of employers. The household survey is a survey of households and employees. So a big difference is that the establishment survey, so the non-farm payrolls counts jobs. The household survey counts the number of people employed. So if an employee has multiple jobs, each job will be counted in the establishment survey, non-farm payrolls, but in the household survey, they won't. They will just show up as that person being employed, no matter how many different jobs he or she has. So the key differences between the non-farm payrolls and the household survey are that the non-farm payroll asked businesses and government agencies about job creation. The household survey asks households whether people in that household are employed. And the trouble is that the non-farm payroll uses statistical adjustments. In particular, it estimates and forecasts the rate of business creation and uses that as an input, whereas the household survey doesn't. It just uses the data as supplied. So that's one problem. Another problem is that responses to the non-farm payrolls survey have collapsed after the pandemic, potentially making it less reliable. But the big concern is the statistical adjustments. So each month, the Bureau of Labor Statistics, who produce non-farm payrolls, estimate how many net new businesses have been created and how many new jobs have been created from those estimated new businesses, and puts that number into the non-farm payrolls. But there has been a substantial increase in their estimate of new business creation post-pandemic. And this chart shows the 12-month moving average in net business creation over time. And you'll see that pre-pandemic, it was running at, on this index, 80. It's now running at 110. So the Bureau of Labor Statistics is estimating that there's been a 40% plus increase in net new business creation post-pandemic. Is that realistic? And here you see their estimate for job creation in November. And according to them, there's been a big increase in leisure and hospitality and education and health services. The big decline was in retail. Construction continued to add jobs, which is puzzling. And if we look at other data sources, such as LinkedIn, who use data from their own website. So the hiring rate in November fell month on month and was 20% lower than in November 2021. So in conclusion, the non-farm payrolls may be wrong. It is depicting a much stronger US jobs market than the household survey. And the non-farm payrolls uses these estimates of net new business creation as part of its survey. And that seems to have risen by over 40% since pre-pandemic. The danger is the Bureau of Labor Statistics is overestimating the rate of new business creation. And so non-farm payrolls is unreliable and it's too high. And while we're talking about discrepancies, let's talk about the ISM Services PMI versus the S&P Global Services PMI. So there's a big gap has opened up between the two. The ISM had a bounce in November, which is surprising and remains well above 50. The S&P Global Services PMI is really bad. So the green line is the S&P Global Services PMI business activity. The yellow line is the ISM. And you can see the two are heading in completely opposite directions. So what is the difference between the two? And I should say, before we go into this section, that this whole section is from S&P Global. And obviously, they think theirs is the better measure. So be warned. Now, the first difference between the two is in sector coverage. The ISM defines anything which is non-manufacturing as in the service sector, whereas S&P Global covers fewer sectors with the aim of being internationally consistent. So, according to the ISM, mining is in the service sector, which is very debatable. Other differences are that the S&P Global samples around 400 companies in its survey. The ISM doesn't declare how big their sample size is, but S&P Global think it's less than 400, so there may be a sampling bias. The S&P Global also attempts to sample a range of companies that is representative of the economy. So it samples small, medium, and large companies, whereas the ISM just samples large companies. And we know that the National Federation of Independent Businesses, which surveys small businesses in the US, well, its business optimism index is low. So there could well be this discrepancy between large and small businesses. In addition, the ISM just surveys purchasing managers, whereas S&P Global say that they include other roles, with the reason that they think that purchasing managers have less of a central role in services companies compared to manufacturing companies, and therefore are less involved in the day-to-day operations of the company and have a less reliable view of how the company is doing. ISM also just asks companies about supply chain management, which the S&P Global thinks is less relevant to the services sector, whereas the S&P Global asks questions tailored to each sector. There are also differences in the weighting system and in seasonal adjustments. Please pause and have a read. So in summary, and first of all, we should caveat all this by saying this is all from S&P Global. We can say there is certainly a huge difference between the S&P Global non-manufacturing PMI and the ISM version. In the ISM, the services sector continues to be resilient and actually had a bounce in November. The S&P Global, on the other hand, showed a services sector in the US which was in decline and fell sharply in November. A very sharp contrast between the two. Now, S&P Global gives a number of good reasons to believe that their index is the more reliable of the two and is more consistent with what we at Portfolio Matters would expect the numbers to be. But the market takes the ISM seriously, more seriously than the S&P Global. We just have to wait and see which of the two is correct. But if we were to have to choose one of the two, our money would very much be on the S&P Global because it fits our prejudices. Okay, on to other charts. So Chinese property stocks have rallied since the government announced its stimulus plan. And as you'll see in a second as I go through industrial commodities, the industrial commodity sector seems to believe that there's going to be a strong pickup in Chinese demand. Now, if we look at the Fed balance sheet, it's only shrunk by 4.3%. So QE has only just got started. And that will continue to tighten financial conditions. And last week, we discussed the link between net liquidity and the level of the S&P 500. As QT continues, the stock market should face continuing headwinds. Please watch our section from last week. And reminder that next week is triple witching on Friday when we have options expiry, and that tends to be associated with market volatility. Now, this chart shows the returns for the S&P 500 in the week after December triple witching, and you can see it's generally a positive week. But, of course, this year is very atypical. Okay, on to good news. So this is the Nantes hydroelectric pump storage facility in Switzerland, which has been built at a cost of $2 billion and can produce up to 900 megawatts of electricity and store up to 20 million megawatt hours. And the aim is that it can be used to store electricity from renewables. So when there's an excess of electricity produced by, say, wind farms or solar, you can store the electricity here by pumping water uphill. So the energy transition continues. And on to equity markets. Well, last week, we talked about how VIX had fallen below 20 and it was time to sell. And that turned out to be very good advice. The all share fell 1.2%, stocks Europe down 1.1%, the S&P 500 fell 3.5%, NASDAQ 4.2%. The Hang Seng bounced a further 4.2% as optimism prevails over China's reopening. Topics was flat, Bitcoin was flat, sterling and euro were flat against the dollar. VIX rose as the S&P 500 fell and is now at 24.2. Fund managers are predicting a better year for stocks in 2023, but they always do that. And to me, this indicates that we haven't yet seen capitulation, and as you know, we are forecasting that earnings will fall next year for a variety of reasons, not least because the world economy will slow, but also because government spending has fallen sharply from the pandemic largesse, and corporate earnings are a function of fiscal deficits. And so we expect stocks to have a bad year next year. And we look at US companies, they've had an absolutely extraordinary run compared to the rest of the world. At some stage, surely this has to reverse. Now, this I found very surprising. This is flows into US ETFs. You see that 2022 was actually the second best year on record in nominal terms, and investors have not given up on this market yet. Okay, on to commodities. So oil had a truly awful week, down 12%, and is now down year on year. So the market is expecting global recession, falling oil demand, and supply and demand to increasingly come into balance and then go into surplus. In Europe, despite the cold weather, natural gas prices continue to fall, so Europe seems to be well supplied with natural gas currently. There is no panic. US natural gas prices rose 4% on the week. Coal rose 4.5%. Uranium drifted off, down 2.2%. So coal is up 137% on the year. Numbers pertaining to the oil market, well, inventories in the US rose by 3.8 million barrels. So last week, the US oil market was well supplied. And if we include releases from the SPR, private stocks rose by almost 5.9 million barrels. Now, is that early signs of demand destruction in the US? It is too early to tell. We can't, 1 week's data is not enough to determine a trend. US total crude production ticked up by 100,000 barrels to 12.2 million, and the Baker Hughes rig count fell by 2. This is crude. Now, one thing we've covered in previous weeks is how oil equities have massively outperformed oil over this year. And so oil is now down on the year, whereas oil equities have had a very good year. Can that continue? Will oil equities now start to fall back down to earth? Fund managers think oil has further to fall, and they have been liquidating their futures. This is EU natural gas futures going nowhere. The cold weather has not caused further spikes in natural gas. This is the UK natural gas futures. US has had a bounce and cold weather there. Coal, the UK has warned that The cold weather may cause it to restart its coal-fired power stations early. Everywhere, coal is the backup power source. It's had a great year. This is uranium, which seems to have found a level. Okay, on to commodities, industrial commodities. Highlights were iron ore, which bounced 6.2% this week. Nickel, also up 6%. Tin, up 6%. Ferrovanadium, up 4.1%. And zinc, up 5.2%. So this is aluminium, down on the week, but the trend seems to be upwards and it's off its lows for the year. This is cobalt, flat. Copper, again, off its lows. Chromium, likewise. Iron ore, surprisingly strong upward trend. Is that the market anticipating renewed Chinese construction demand, or is that actual Chinese construction demand for steel? We'll just have to wait and see. So lithium had an amazing year, but now off its highs. Neodymium, nickel, up 6% on the week, but actually down from its intra-week highs. Seems to be developing a new bull run. Tin, also off its lows, although well done on the year. Ferrovanadium, also well off its lows. Zinc, the same. So the industrial commodities have all had actually surprising strength. That suggests the Chinese economy is actually recovering. Onto precious metals, gold was down 0.6%, silver up 3.3% and is now up on the year. Platinum down 1.4%, rhodium down 5% and down 10% on the year. So that suggests the car industry, at least, is not doing very well. Palladium up 1.5%. This is gold, silver. That's a good bounce. Can it last? And this is a chart sent to us by Ali Broyd from our Discord. And you can see that the ratio of silver to the money supply is towards its lows and at levels where previously it has tended to bounce. We shall see. Platinum, rhodium drifting off, palladium flat. Okay, on to rates. And it was a bad week for rates. UK yield curve rose across the curve, particularly at the long end. And the short end, the 2-year, rose by 17 basis points. At the long end, the 50-year rose by an enormous 25 basis points. More on that later. In Europe, we also had rises in yields. So the Greek 10-year was up 13 basis points, Italian up 10. But those remain well off the highs of earlier in the year. So the market is not currently overly concerned about a return of the Eurozone crisis. Now, one of the interesting things about the market this year is the positive correlation between stocks and bonds. And so what seems to be dominating investor concerns is inflation and interest rates. And that can conceivably continue as long as earnings remain strong. If you think of both bonds and equities as providing a steady stream of interest or dividends, then as long as that is expected to continue, then the price is just a function of interest rates. If earnings come into question and start to fall as a recession hits, then you'd expect bonds and equities to decouple. And then the greater certainty involved in bond interest payments relative to dividends should lead to bonds outperforming. The US non-farm payrolls initially caused a sell-off in US 30-year yields but that rapidly reversed. So the way I interpret this is that the strong non-farm payrolls data means that the Fed is likely to have to raise rates higher for longer in the short term, but the market believes that that will cause the US economy to slow harder and lead to stronger falls in inflation in 2023. So long bond yields actually fell. This is the UK 10-year, kind of reached a plateau. It was up on the week, but not enormously so. This is the UK 30-year. And that has, sadly, for me, had a bounce. So the previous trend has been broken. Is it climbing back up again? US 10-year, you'll note that the UK 10-year now yields more than the US 10-year. And that is a real break from the last few years where the UK bonds have yielded less than the US. So Eurozone bonds have had the lowest yield, and UK bonds have been halfway between higher yielding US bonds and lower yielding Eurozone bonds. Well, now US 10 years are below UK 10 years. So does that mean the market has more confidence in the outlook for US inflation than for UK inflation? This is German 10-year, Italian, well down from its highs, Greek, also well down from its highs. And now turning to the seasonality chart, well, in a normal bear market, December is an indifferent month. And so far, we have seen that the S&P 500 has fallen 3.5% over the last week. So if it continues with the traditional seasonal pattern for a bear market, it will stage a slight recovery over the rest of the year, but not have the traditional end-of-year rally we see in bull markets. This is our view of the various asset classes, which remains unchanged. And finally, concluding comments. Well, it was a dramatic week in the oil market, and that suggests that the world economy is slowing, and the oil market is sending a signal of reduced oil demand destruction there, and that is bad for the world economy. On the other hand, industrial metals are staging a bit of recovery from their earlier lows, which suggests that the Chinese economy is doing better, and that government stimulus there in the form of cheaper loans to the construction industry will get the construction sector going. But overall, the picture is of slowing global PMIs and a global recession in 2023. And onto my own portfolio. Well, I had a poor week. UK long bonds continued to sell off, and I was down 2.2% on the week, down relative to the all share, which was only down 1.2%, but I continue to have a good year. But a reminder, I play the cycle, and timing the turning points in any cycle is always difficult. I'm always too early, and you expect to lose a bit of money before it comes good. Didn't do any activity, no buys, no sells. My asset allocation was unchanged. Now, this is the US 20-year ETF, IBTL. And you can see that although UK long bonds had a bad week, in the US, long bond yields fell across the week. So my losses in UK long gilts were partially offset by gains in US long bonds. Now, IBTL is not hedged. You're just buying US treasuries. And over the last couple of weeks, we've seen falls in the US dollars as interest rate expectations in the US appear to have peaked, in which case we know that the US dollar appears very overvalued on a PPP basis. So we at Portfolio Matters have gone to neutral on the US dollar. And if you want to avoid taking US dollar risk, this is a superior instrument. If you want to gain exposure to US long bonds, this is the iShares US Treasury 20-year plus sterling hedged ETF. So you're not taking any sterling risk, any exchange rate risk if you buy this. And you can see that over the last couple of weeks, it's done better than IBTL. Unfortunately, I can't buy this because my stockbroker won't allow me to, but I would if I could. If you are thinking of buying US long bonds, then this is likely to be the superior instrument. However, I will hedge that by saying that next week we will do something on the outlook for the dollar. And the world has a lot of US dollar denominated debt. And in order to service that debt, it needs dollars. Now, it can achieve those dollars if the US is buying exports from the rest of the world. If the US goes into recession and cuts down on those exports, then the supply of US dollars with which foreigners pay the interest on their US dollar debts declines. And that means that foreigners find it difficult to obtain the dollars they need to pay their debts, and they have to bid up the dollar. So the dollar could strengthen again as the world economy slows. And this is the UK 2071 gilt, and that has drifted off over the last couple of weeks. And this is the 2068 gilt. Now, I bought this in tranches a few weeks ago at the beginning, in the second half of November, and the maximum price I paid was 120. So as of Friday, it fell to 98. So that's best part of a 20% fall in the price since I bought the last tranche. So this is a very volatile instrument, and those falls are painful. But at a price of 98, you are getting a positive real return on these index-linked gilts to maturity. And reminder, capital gains on index-linked gilts are tax-free. And that makes index-linked gilts a very good investment for private investors who would have to pay capital gains tax on any other instrument. So if inflation is, say, 2% long term, then in order to match the return of index-linked gilts, you would need to make 2.5% in a capital gain on equities, say. If inflation is 3%, you would need to make 3.75% to match the 3% return on index-linked gilt. The higher inflation is, the more attractive index-linked gilts become on a tax-adjusted basis. So if the 2068 index-linked gilt falls much further, I shall simply buy a lot more and hold it. We shall wait and see. Okay, that's it. Apologies for it just being myself this week. Richard sadly has a job on Mondays. Reminder, we are in disrupted holiday schedule. I am actually on holiday again from tomorrow, back later in the week, so I will try and get something out this weekend. In the meantime, please can you press like and subscribe to the channel, and it is goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, We make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.